Welcome back. Quick check. How many of you are targeting the US as a primary market? Not surprising, the US is the top choice across responses. And how many of you are looking at UAE or ASEAN markets? Fantastic. This is exactly the multi-market strategy we are seeing across IITM startups. And we are entering multiple markets. Structure becomes even more critical. Compliance becomes even more complex, and mistakes become even more expensive. So now I welcome Ventura Pranas team to take us through cross-border structuring and compliance. Ms. Prabha Srinivasan, founder and CEO of Ventura Pranas. She has over 30 years of experience in the cross-border space. Over to you, ma'am.
Thank you, Madhav. Can you hear me okay? I want to just register a quick vote of thanks to IITM for making this possible, to Professor P.V. Mahesh, without whom I wouldn't be here, Madhula and our CEO, Madan, Narayan, all of them have been instrumental in making this happen. So I'm going to jump right into it in terms of who we are. So Ventura Pranas is a one-of-a-kind cross-border advisory firm that does everything from structuring to setup to dealing with accounting, audit, compliances in US, India, and Singapore, all of it under one roof, okay? And we operate, in the US, we operate out of Los Angeles, the Bay Area, and New York. And in India, we're out of Chennai, Trichy, and Bangalore. So we're in your neighborhood. You have a question, you know where to come. Moving on, I'm going to keep this pretty brief in terms of going through the agenda because we're covering a lot of countries and topics in a very short span of time. And because of the paucity of time, we've cut short a lot of case studies. We had some fabulous case studies we've done at previous talks, but we're going to touch upon it very briefly so that you understand it, okay? And the whole idea here is to make it hands-on. The previous presentation was quite generic, but here the idea is that you as a founder, when you go to a go-to-market person, you need to figure out what they're saying and not hoodwink you. You have to ask the right questions and understand what you're being conveyed, okay, and or offered. So we're going to take you quickly through structuring, followed by a choice of states. So I'm covering US. We will cover other countries in a moment, just after this presentation. A choice of state in the United States, a choice of entity, both of which are very important discussion items. And then we cover a little bit about the tax framework. There's a federal and state tax bill in the US that you always have to worry about. Then we cover how this is going to impact your cross-border liability. And then I come in and talk about incentives, and we're only covering federal incentives now. There are a bunch of other incentives, not to mention state, and there are over 50 states in the US. So we could just have a session only on incentives if we choose to. And then we're going to talk a little bit about the arm's length pricing that Mr. Chandy covered. We'll cover a little more detail for you to understand why it's in place. And then, of course, we talk about M&A. He did touch upon a few items, but here we actually get to understand how it's going to impact you as a founder and the VCs who invest in it. And then finally, I come back, no IPO, no exit is complete without you compensating your employees, and we're going to cover a little bit about what this means for the employees. And I come back and summarize. So with that, we move on to the very first slide, which essentially is what was discussed ad nauseum in the previous session, which is just about what are the factors to consider when you structure. But I'm going to make it a little more practical for you to understand. When you're talking structure, it's important to pause as a founder and do it right from the get-go. If you go back to fix things at a later point, there is always, I cannot imagine a circumstance, very, very rarely will you have an ability to flip structures without a tax consequence. Mix this up with multiple jurisdictions, it's going to get even more complex. So when a person or a founder decides to talk about structure, the first question becomes, where do I hold the parent, where do I hold the sub? That cannot be answered without answering some basic questions. Where is your customer base? This was brought up earlier. Is it going to be US or India? In the past, a lot of companies built in India but sold through the US to customers in the US. That is changing with more and more companies trying to serve an Indian clientele. The second is, where are you going to raise your funds? The US continues, not to take anything away from Silicon Valley, it continues to be a great ecosystem for entrepreneurs, but India is changing. More and more more funds are setting up structures out of India so they can invest directly in companies like yourself, so you don't really need to go outside. So that's an important question. Do you really need to go out in the US? If you do go out, it may be a very different structure. It may not be a parent, it may be a sub. The third one is IP. This was also discussed earlier. You always have to balance safety with rationale in terms of revenue visibility, right? And safety, I think the US trumps India. There is no doubt about it. India, anybody can pick up your IP and start something and say it's not yours, it's out there. But when you're talking about investors and the pressure they put on you in terms of where you want to exit, they may want to leverage it out of India. So the question is, how do you balance that? And then we talk a little bit about access to money. You're all in it because you want an exit at the end of it. And how you're going to access that money is critical. And it's not just about you today. What if the investor pool says you have to move to the US? Then you become a resident in another country. What if your children decide to move outside? They may not be very happy with the fact that the money is all stuck in India and they can't take it out, right? So that's a consideration as well. And then we talk a little bit about effective worldwide taxes. When you start putting companies across countries and jurisdictions in place, you're always going to have to deal with the tax in that jurisdiction, and then the layers that it attaches, both at the company level as well as at the founder level. And that impacts worldwide effective rate. It is not enough that you just judge taxes at a particular jurisdiction. You actually have to simulate these across the entire revenue cycle through an exit and see where the numbers fall. And last but not the least, are you a service or a product? A product company, the choice of state can be very different in the US, and then the service can be very different. IITM has a Menlo Park presence. If you set up and use their space, you could be looking at a California registration. Those are things we will talk about. And then finally, where are you building? More often than not, you're going to be seeing an Indian team that is building it and selling. And where is your R&D has a bigger impact in terms of where you're going to be able to harvest incentives. The US has a lot of incentives, but clearly it is because they want to nurture development on US shores. Okay, so with that, I'm going to move on to Madhu, who's going to talk a little bit about the type of US entities.
So, thank you, Prabha. Hello, everyone. Let's now look into the different legal structures in the USS. A limited liability company, a C corporation, and an S corporation. So, let's understand this with an example. Say there are three founders, A, B, and C, who decide to set up a company in the US. The first thing that would come to their mind is to set up through an LLC. It is the most simplest structure. Whatever the company earns, it will pass on to the shareholders or the members, and they pay taxes at their individual tax rate. This is pretty straightforward. But when you want to scale up or expand your company, investors might not be very much comfortable with this structure, given that foreign owners are involved and it is pretty complex in terms of investments. So, LLC would not be your ideal option. Now, there's an S corporation. The functioning is similar to an LLC, but one downside is that only US citizens and residents will be able to become shareholders of an S corporation. So, for cross-border startups or for Indian founders setting up a company in the US, this is not your option. Then comes the C corporation, which is the most preferred one. So, in a C corporation, the entity and the founders or the shareholders are considered as two different persons. This type of structure is actually preferred by venture capitalists because it allows you to issue stock option to your employees, sign contracts with other US companies, bring in advisors, and also helps you to issue instruments that are for external funding, which the most venture capitalists are comfortable with. So, among the three choices, our founders A, B, and C would still go with C corporation. So, of the three, C corporation is your choice. Now that we have looked upon the types of entity, let's now move to jurisdictional consideration. So unlike India, where most of the companies are governed at the national level, in the US we do have 52 states and each state has its own specific laws. So if you're going to register your company in Delaware or Texas or New York, then you will have to follow that state specific rules. You can incorporate in one country, but you can operate in another. You can incorporate in one state, but you can operate in other states as well. You have 52 states. For example, if you're incorporating out of Delaware, but you have your team in California or New York, then you will have to get registration of that state and comply with that state law as well. So there is no one size fits all answer here. The state where you have to incorporate things upon many practical considerations, like where the founders are based out of, which is you, where you have your team out of, where you want the external investors out of, how is your cost and ongoing structuring based out of, and how do you want your exit to be planned. So what you're seeing on the screen is few most commonly chosen states by the tech companies. The most common state which you will hear upon is Delaware. Delaware is investor friendly and it has very strong corporate laws. There's shareholder protection also there. So when you want external funding, VCs would always prefer Delaware. Then we have California. You will find most of your tech talent pool out of Silicon Valley. You can incorporate yourself in California. You can have a team in, incorporate yourself in Delaware, have a team in California, but then you will have to comply with Delaware as well as California laws. California compared to Delaware is a bit more complex and has stringent compliances to be followed. Then we have Texas. Texas has no state income tax, but then you have franchise tax if your income exceeds a particular threshold. So when you hear people say Texas is a no tax-free state, it is not the case. You still have a franchise tax. We then have states like Florida where there's low corporate tax. It is more simpler compared to the other three states, but then this is mostly preferred by consulting and e-commerce businesses. We also have New York, which has stronger ecosystem. It also has more complex laws and labor laws and liability protection, but then this is preferred mostly by fintech and media tech companies. We also have Nevada on the list, but then Nevada, when it comes to external funding, it is not your choice to go for. So of the three, Delaware is your first choice, followed by California and Texas. Let me explain this through an example. So when you decide to incorporate in your state, you will incorporate in whichever state you want to. The first question you should ask is whether you have a team out in any other state or if you have a physical presence in any other state. If that is the case, then you will have to register in that state and comply with that state laws as well. The next question you should ask is, are you planning to invest through a VC? If so, check whether your company is IP driven or service driven. If it is IP driven, then Delaware is your choice. If it is service driven or more of cost driven, then you could go for states like Florida, Nevada, or Texas. So to summarize, you can incorporate in any state where you want to. You can register yourself in any other state where you have your nexus out of, but you will have to comply with all the state laws. Now that we have looked upon the states, I'm just handing it over to Ramya to discuss about the taxation part.
Good evening, one and all. Thank you, Madhav, for things. So now that based on the previous session, we understand that C corporation is the best structure to go for a cross-border expansion or for the startups. Now let's look into the federal taxes and the state tax obligations and the key considerations in both the sections. So the first thing is the federal tax. So federal tax, so as I mentioned earlier, corporate is a separate legal entity and it pays taxes by itself. So there is no pass-through at the corporate level. In case of a partnership or an S corporation, it is actually a pass-through entity and tax in the hands of the shareholders or the respective partners. So in terms of the corporations, let's see what's the tax rate at the corporate level. So the tax rate is at 21%. So that's a flat rate. There is no incremental rate. It's a flat rate of 21% and it gets taxed at the corporate level. So how this works, let's see the process. So the corporate earns income. After deducting the expenses, the net income will be taxed at a 21% and then it distributes the profits to the shareholders. At the time of distributing the profits to the shareholders, it will again get taxed in the hands of the shareholders and it will be taxed either as a dividend income or a capital gain based on the earning and profit at the time of the distributions. So that's why we say it's a corporation, but corporation, the major drawback of the corporation is the double taxation. One at the corporate level and the second at the individual level or the shareholder, whoever earns the dividend or a capital gain from. So after looking into the taxation part, there is an important thing which is a compliance part. So especially when there is a startup and they are in the initial stages, it is very, very important to keep the compliance right. So this compliance is for the tax returns, it's a generic form, which is a form 1120 that needs to be filed with the department. But along with the form general ITR, equivalent to India, there is a FAT curve forms which is obligated to file it with the IRS. So especially if an Indian parent and a US subsidiary, or in vice versa, where there is a Indian subsidiary and US parent, there are many FAT curve forms which has to go along with the US taxes. If non-compliances of the FAT curve form, there is a hefty penalties in US which goes up to $25,000 penalty. So that's the situation in case if you're missing any kind of a non-compliances. And another important thing is there is no self-employment taxes in case of a corporation. So now we looked at the federal tax, let's move on to the state taxes. As Madhu mentioned, you all have to incorporate in one state and you have an option to foreign register into multiple states whenever there is a nexus. So there are multiple tax rates. So as we've seen in the federal, it's a 21%. For the states, it's a different tax rates applicable. So it can go from like 0.375% to 8.7% for the Delaware. Just to give a top line, so it's Delaware at 8.7% and California is at 8.84% at the state level. This is on top of your 21% at the federal level. So let's see when it applies. So basically in terms of the state taxes, it will be bucketed into two major direct taxes. One is the income tax and another is the franchise tax. So income tax is basically depend upon the income proportionated to the respective state, and then there is a concept called franchise tax. Let's understand, let's be it in the comparison. In India, there is an ROC concept. So where you have, if you have a private limited entity, then you have to adhere to an ROC every year. Likewise, if you have incorporated in any state, say for example, it's a Delaware state, and if you have an employee works out of the California state, in that instances, you have to foreign register your California in the California state. In that instances, both Delaware and California imposes you a franchise tax requirement. So along with your income tax obligation, you also have to file for a franchise tax to keep your entity active in that respective state. And the nexus, it is not like only at the time of incorporating or foreign registering in any particular state, there is a state filing obligation. So it basically depends upon the nexus. So nexus, how it will be determined. So there are three major factors which obligates a corporation to file their tax return in a respective state. So what are the three obligations? Is a sales factor, payroll factor, and the property factor. Sales factor is basically when you earn income from any respective states, and each state have their own thresholds. And if that state threshold crosses, then you have to file a state taxes in that particular state, even if you don't have any registry in that particular state. And if a payroll, let's take an example here. It is incorporated in Delaware, but you have an employee in New York, then you also have to file a tax return in the New York state. And another example is a SaaS company where they provide services across the states, right? So in that instances, if they earn income from multiple states, then they have to file tax return in multiple states. And one major category here is it is not a double taxation at the state level. The states apportion the income based on what they earn from respective states and tax it only on their apportioned income. So there is no double taxation instance in this scenario. So now we've looked at the state and federal tax considerations. Let's move on to the cross-border considerations. So what is in the cross-border consideration? So immediately something which comes into your mind is like, okay, I'm going to get paid from the US corporation. Am I subject to taxes in the US? So the first question you have to ask is what type of an income you are earning from the US corporation. And based on the type of income, there is a withholding. So withholding is a concept like it is basically introduced to avoid any kind of a tax evasion at the sourcing country. For example, if someone is providing a services from India to US company, and US will pay you as a service provider, in that instances, they will be actually deducting a withholding. But that withholding rate, how it will be determined? So if you are from a non-DTAA country, so DTAA is basically a double taxation avoidance agreement. So if you're a resident of a non-DTAA country, then the flat tax rate is at 30%. So there is no outweigh there. So the 30%, the US provider will take it out, and in wherever the country you are a resident of, you can claim the reliefs in that respective country. But if you are a resident from a DTAA country, then there are different tax rates whichever is applicable based on the payment how you are actually receiving. Let's go with an example here. So if an Indian entity who provides a license to the US to use and produce income at the US level. So in that instances, the US will be paying royalties to the Indian entity. In that instance, when they pay the royalty income to India, US will deduct about 15% or 20% in terms of the withholding and pay the remaining to the Indian company. So, and in India, when they file the tax returns, whatever has been withheld, they can actually claim it as a relief. So this relief is covered under the section 90 in India. So that relief can be claimed, and in India you will be paying only the residual taxes but not the double taxes. And say for example, if the income is going to be a dividend income, in this instance, let's take an example of Indian parent and a US sub. Let's assume there is a two shareholders in the US entity. One is a 95% parent, which is an Indian entity, and maybe another 5% with another Indian person. So in this instances, for the dividend income declared by the US entity, the Indian parent will be withheld at a 15%, and the another 5% holder will get a 25% deduction. So the DTA will comes in a greater role when there is an agreement between US and India. So US and any country whichever has a DTA. So the basic thing what you have to do is you have to produce with a form W8-BEN or a form W8-BEN-E to declare that you are a resident of a foreign country which has a DTA, so that you will get a reduced tax rate obligations. And moving on to the next category is the foreign derived intangible income. This is a concept introduced by the US to encourage the US domestic corporations to have their market outside US and earn income from the outside US. How this is going to help us? So it's basically will give a reduced tax rate when there is an income derived from the foreign sources. Say for an example, US is a domestic entity and it has a markets in UK. So what happens here is whatever income, so if it is 100K of an income earned by the US entity, out of which 50% is from the UK sources, then only 50% will be taxed at a 21% as we discussed earlier, and the remaining 50% whichever earned from the UK will be taxed at 13.125%. So it's basically a lower percentage which will be applied on your sources from the foreign market. So the major category of people who will get benefit is definitely the service providers, SaaS company who provide services across the country, export people who export and earn income through their exports across the country will get a greater benefit of FDII. So with that said, in the federal, state and the cross-border considerations, I will now hand it over to Prabha on the incentives available for the startups.
Thank you, Ramya. So as I mentioned, because of the paucity of time, I'm just going to cover some federal incentives. We're talking to a deep tech audience, so I'm sure R&D is a big part of what you do. And the US has provided for some incentives. It's not just the deduction for the costs you incur, but it is also a tax credit, which means it's a dollar for dollar reduction in your tax bill. What you just saw, the 21% plus your state tax bill gets reduced for any R&D work you do on US shores. And what is covered is not just the cost of salaries, it includes, not just direct costs, but also support and supervision costs are included. And it includes wages, benefits, all kinds, supplies, access to labs, all of that applies. So if I were to apply it in a practical situation, if you had a startup out of IIT Research Park that hired a top-notch CTO in the US who has the domain expertise, then any cost that he drives, his salary, his benefits, will be eligible for the purposes of computing the R&D credit, okay? So how do you demonstrate this? You have to keep time records, you have to have MSAs. Mr. Chandy covered this as well, saying, you know, when you're doing development work across shores, so this is precisely the circumstance that you would see it. Flip the coin, and let's say you have a group of people in India who are doing the R&D, those costs would not be eligible for the R&D credit in the US. So that's about the R&D, and then I'm going to talk about the qualified small business stock benefit in the US. This is the single biggest, most common reason why VCs would want to invest in a C Corp in the US. And it is governed by the Section 1202. There are a bunch of conditions, but what it allows investors to do is to exempt a big part of their capital gains from taxes. I'm going to give you an example, and when I say founder, it applies to a VC pool as well. Now and I'm going to talk about a pre-2025 regulation, because under the one big beautiful bill that has become an act under President Trump, the rules have become revamped and even more favorable. But let's take an example of a company that was pre-2025. The founder put in $200,000. He gets an exit of about $15 million. He's allowed to exempt 10 times his basis or $10 million, whichever is higher. So out of his $15 million, he basically exempted $10 million out of those gains from taxes. Now, if he had been smart about it and talked to us, we would have told him to split his ownership across 2 trusts or 3 trusts. So between himself and 2 trusts, he's now sliced his payout as $5 million across 3 holding structures. He's just exempted 100% of his gains. You will see this happen with every VC firm. The GPs will come in through their trust, their individual's name, all of that will happen, and that's precisely why they're doing it. The rules have become even more favorable in 2025. They've increased the threshold to $15 million. So again, it's the same principle, 10 times basis or $10 million. The more number of people who hold it, then you're getting a multiplier impact on that, okay? Remember that this is a federal-only rule. There are state taxes, states that are not necessarily QSBS compliant. A classic example is California. They want to get every dollar they can, and they know that the biggest number of startups comes out of California. But we do some planning with these founders. We talk to them 2 years ahead of time, move their footprint to a different state where they can also become eligible for availing this QSBS benefits. If you're a founder who has a QSBS eligible company in the US that is being bought out, but you're resident in India, India tax will be the only thing you will pay. You will not pay US taxes, okay? So huge benefit, guys, so you should pay attention to that. Aside from that, there are 2 other important incentives which I thought were pertinent to talk about. The Section 179 is basically accelerated depreciation. The conditions are that you should be profit-making, the assets you put in place should be new, and it can't throw you into a loss. And you can make up to $4 million in investments and write off close to $2.5 million of that as a first-year depreciation, assuming you have the profit to support it. And so take an example, a company is that making about $250,000 in bottom line before depreciation. They've spent $200,000 in equipment. It can be laptops, it can be, you know, everything you need to do your coding. All of that can be written off, and you're only going to be paying tax on $50,000 because your $250 just got muted to $50K. You're saving federal and state saving, you know, dollars in the first years of operation to plow back into the business, and that you're not spending in taxes. The next one is an accelerated depreciation provision. This is even more tax friendly. It applies to both profit as well as loss-making companies. It can be new or old equipment, and there are no limits. You can write off 100% of the equipment you actually put into service in that year. And take an example of a company. Most of the deep tech companies or AI companies even today are spending so much on infrastructure. They're all in losses. They're probably writing off all their data center costs. But this is the play. If they have $1 million in losses, they've got about, say, $5 million that they spent on hard assets. They can write off all $5 million and take their losses to about $6 million that they can carry forward indefinitely and optimize taxes against future earnings. We'll be covering a little bit on NOL in a bit. So that's the main incentives. I'm going to turn it over to Sai, who's just going to talk a little bit about what are the legal agreements, MSAs, the 4 pillars. So he'll give you a little insight on that.
So a very good evening to one and all present here. Thank you, Prabha. So let us take a walk through on how a typical US expansion looks like. At a higher level, we can see there is an US entity and there is an India entity. While the US entity is responsible for the revenue center, for example, vetting the contracts with the customers or dealing in a high level contracts and taking on the strategic business decisions. So this being the main revenue center. While India being the cost center, it provides research and development services and also on the offshore support services. Here, India provides the services to the US entity. US in turn pays the amount to the India entity, which is at a cost plus, for example, say 15 to 20% markup at a high level. Now, with that said, let us go on and see what are the 4 pillars that define these transactions going forward. There are 4 pillars. Firstly, on the transfer pricing. Secondly, on the legal agreement. Thirdly, on the operation flow. And fourthly, on the US complaints. Coming on the transfer pricing. So what is a transfer pricing? There is an entity in India and there is an entity in US. So they are connected by virtue of shareholding. For example, say more than 51% shareholding. Here we can say that these are connected by way of the transfer pricing transactions. The government is interested in these type of transfer pricing transactions because they wanted to ensure that the profit is not getting shifted to the other jurisdiction. So normally entities or the countries have a specific focus on these transactions. The best practices to follow here is to have a transfer pricing policy and to have a consistent benchmarking and to ensure consistency and to review it annually. That comes to the second part called as legal agreements, which is also called as the master service agreement, which defines and which is a key factor to the transfer pricing agreement. The master service agreement focus on 3 aspects. One is on what is the scope of services offered, as in the services which is offered from the parent entity to the subsidiary entity, which is in 2 jurisdictions. Secondly, on the what is the profit allocation. So they have predetermined terms on what would be the profit that has to be shared between the 2 entities. Thirdly, on the risk allocation. In the near future, every business is prone to risks. So it will have a proper risk allocation. So before entering into any operational flow or any transaction, it is a must that the legal agreements are executed in line with the transfer pricing reports. So that brings me to the third part called the operational flow, which is also called as the import-export considerations. Before that, one key principle is that all these 4 pillars should be aligned for a successful typical US expansion. So that brings me to the third part of this US side consideration. Similar to India, there are some statutory compliances in the US. So same case, I'm taking it for an example. There is an entity in India, there is an entity in US. So both countries have to follow the statutory compliances. Similar to what we have in India called as Form 3C-EB, which is governed by Income Tax Act. We have a form called Form 5472 in the US. While in India, we report in Form 3CB what is the transaction centered and what is the arm's length price and what is the value. That brings me to the second question of what is the arm's length price. So for example, by virtue of nature and by virtue of relationship, there might be instances, for an example, if a 10 rupees product is sold to the related party at a 5 rupees price. So there is a loss of 5 rupees to the government, or technically the tax loss of the 5 rupees. So to avoid this, there is a concept called an arm's length principle. Arm's length principle determines on the same transaction, if it is made to the third party, what would be the price. So any transfer pricing agreement or any master service agreement should align to this cost basis. And coming on this path, we have to file a form called Form 5472, which validates on the arm's length pricing validation. And also coming to India thing, apart from filing the Form 3CEB, there is also certain documents that needs to be taken care, rather in terms of documentation, which also forms part of the tax return filing, which we do on an yearly basis. This is for example, this is for services. Coming to the goods, there are some customs requirements for this classifications and the evaluation of duties. There are 2 risks evolved here. One is when there is an overvaluation, the tax authorities may question on the profit allocation. But when it comes to the undervaluation, the customs may challenge. So to avoid these kind of complications, we have to ensure that the transfer pricing, master servicing agreement, and the invoicing are aligned, and also to maintain a consistent documentation. That brings me to the fourth part, called as US sales tax compliances. Similar to what we have in India called as GST, we do have in US called sales tax. But it is a bit different from what we have in India. In India, there are transactions, or we are liable for GST only when the amount crosses the, as in when the registration is liable only when it is upon a certain threshold. But in US sales tax, apart from the threshold, there is something called nexus. It is triggered by two factors. One is on the physical presence and the other is on the economic presence. While the physical presence deals with office, the employees and the warehouse, for example, the economic presence is based on more of financial nature. Say, for example, $100K transactions or 200 transactions. When it comes to a tech firm, software as service is a core area. So an in-depth sales tax analysis has to be made on a state-to-state basis before coming into any conclusion, because there might be misconceptions where in one state, for example, in California, I pay certain amount of sales tax. In other state, there is no such sales tax. So that should not be the case. There should not be any generalized assumption. An in-depth analysis has to be made on a state-by-state basis. And here are some of the compliance requirements. So we have to register in the relevant state, and we have to file the sales returns and collect the sales tax and maintain the records. So to sum up all these up, a successful US expansion isn't just about incorporating there and taking part of compliances. We should also align with those of the economics and the legal structure of that particular country, and to be coherent and to be on an audit ready perspective. Over to Preetika on the M&A and expansion plan.
Thank you, Sai. Good evening, everyone. So this section examines how value is realized as a business moves through a transactions. So in merger and acquisitions, the commercial deal often looks simple on paper, but the tax outcome generally depends on how the transaction is structured. So let me take you through the transaction side of the story first. Take example of an Indian parent company with a US operating entity. And let's say over a period of time, the US business acquires value, right? And at this point in time, a buyer might want to acquire the business. So there are two options. If the buyer acquires the shares of the company, then the shareholders of the company directly recognize the gains, and that fits into the capital gains framework. Alternatively, if the buyer acquires the assets of the company, then the income from that sale will be reported and taxed at the corporate level first. And then when those sale proceeds are distributed to the shareholders, they will face tax at another level. So the acquisition of shares by the buyer offers a more cleaner exit, because there the value moves directly from the buyer to the shareholder. So this is where the double taxation actually becomes relevant. Think of a cross-border scenario. We will have one more layer here, which will be the withholding tax and the treaty implications, as we saw in earlier slides. So the practical message here is pretty simple. The transactions economics do matter, but the structure often determines the tax outcome. With that said, let me move on to the next part. So when we say that the business acquires value over time, it may also have built some tax attributes along the way. And that brings us to net operating losses, which is the NOLs. So net operating losses arise when the deductible tax expenses basically exceed the tax outcome. So this is pretty much common in all the early stage and high growth businesses, where they intend to spend more on product development, talent acquisition, and infrastructure. So why so much about losses? So what makes NOLs really interesting is that they're not just historical losses, they may represent future tax value. How? So when these businesses become profitable in the future, these net operating losses can be used to reduce those taxable income in the profitable years. So this will alternatively subsequently improve the after-tax cash outflows. And this is exactly why NOLs are pretty much important for all the AI and tech startups, where these early losses are often built into the growth model. So with that said, yes, NOL does have value, but will the value survive when there is an ownership change in the company? And that's where Section 382 comes in. So its policy is pretty straightforward. The law does not want a company to be acquired purely for its tax losses. So when there is an ownership change, your ability to use the NOLs to reduce the taxable income in the profitable years might be subject to an annual limitation. So why this matters is that this impact will directly have an influence on your valuation, the transaction structuring, and all the following compliances. So yes, NOLs are important, but how we structure the transaction also matters. That said, let me move on to the broader structuring point, which is the tax-free reorganizations. So this is a situation where the business actually changes form, and that might be through mergers, share exchange, or asset for stock deals, or insertion of a parent company without an actual immediate cash exit. So the catch here is that it's not actually tax-free. Tax-free reorganizations essentially mean that the tax is only deferred and not eliminated, and that too only when there is genuine business continuity rather than a sale in disguise. So there are so many types of tax-free reorganizations, as you can see, and each of it comes with its own structural complications and tax consequences. Now that we have seen the company and the shareholder side of the story, let me move on to the employee side of the transaction. So now we move on to the employee stock option plans. So typically in an ESOP, the employees of the company will be granted an option to acquire the shares of the company at a later point in time, usually at a fixed exercise price. So the life cycle of a stock option is basically grant, vest, exercise, and a sale. And in a US scenario, there are broadly two categories, which is the ISOs, the incentive stock options, and then we have the NSOs, which is the non-qualified stock options. So what happens is, under an NSO, let's take an example where an employee is granted an option and the grant price is $5. And he can exercise the option at a later point in time, and the value of the option at the point of exercise is $15. So the spread, the $10, is often taxed as compensation income, and any appreciation on the share value over the $15 will come under the capital gains framework. So while talking about ISOs, they are more favorable from a tax standpoint, but there are certain conditions to be satisfied in that case. Let me compare that with sweat equity. Sweat equity is wherein the employees are directly offered the shares of the company instead of an option to acquire the share at a later point in time. So here there are two conditions. If the sweat is vested outright, then the tax incidence is only at the point of sale when the employee decides to sell those shares at a later point in time. Alternatively, if the sweat equity comes with some vesting conditions or forfeiture clauses, the tax incidence is deferred until the point of vesting unless you make a special election. And that is where the 83B election comes in. So what that election does is, it basically allows you to pay your taxes at a very low value at the grant stage itself, and any future appreciation will thereafter be taxed under the capital gains framework. And this is particularly efficient where the value of the company is typically low at this point in time, and you expect a great upside in the future. That's it. Let me now give you a quick glimpse into a scenario where the US employee is granted the options of an Indian parent company. So just because the company is Indian doesn't mean that the option is automatically disqualified. What we'll need to analyze is whether the Indian parent company fits into the puzzle, where it should be the right kind of US corporate provider for the options to be treated as ISOs. So the US laws does lay out some conditions, and if the Indian company satisfies those conditions, then the options granted by the Indian parent to the US employee will be treated as ISOs for US tax purposes. And as we saw earlier, ISOs are favorable from a tax standpoint, so this is more of a win-win situation. With that background established, I'll now pass it over to Prabha to quickly bring the discussion together and summarize the key takeaways.
Thank you, Preetika. So there you go, guys. We're at the end of our segment. But in order to just quickly summarize where we started, we talked a little bit about all the factors you have to consider in structuring. We established that the C Corp is possibly what you're going to be working with if you're Indian resident and an Indian parent setting up an entity in the US. We talked about federal and state taxes. I want to point out that although Delaware was touted to be one of the best and it has a high tax rate, you might ask why you're pushing me there. The fact is, if you're actually selling as an IP or generating income from IP, it's tax-free in the state of Delaware. It's really where your other sales happen. We established the federal and the state taxes. What is the federal rate? The state taxes is usually between 4 and 6%, depending upon the basket of states that you hit, based on where your employees are, where your property is, and where you actually sell. We talked about how companies can actually you can own an IP in India, license it to the US, they can sell to the rest of the world and pay an 80% lower tax on those sales in the US versus the 21% rate. Then we talked about incentives. We touched upon R&D and how you can actually doing work out of the US gives you a reduction in taxes. You can accelerate write-offs and generate losses in the initial years, at least for tax purposes, and save tax dollars. And then we talked about sales tax and MSAs and what you need to do. So don't discount sales taxes. I come across so many use cases where we're doing the due diligence at the time of exit and the company is just completely overlooked sales tax. They just say, well, we're a software company. We didn't think it applied to us because it's not a good, but that's not true. Every state has its separate rules. And finally, we come to M&A, where we've talked about what it means for employees, what it means for the founders, and how you structure that at the time of exit has a profound impact on the amount of taxes that you will pay. And so that brings us to how we can help you. So we can be your partner in this journey from the time you conceptualize to the time you take this to your exit. We will help you set up, account, report, tax, comply. And we do that for US, India, and Singapore. And where we don't do it, we partner with the firm Aspera. I now have Manish, who is here with us. He's the Director of Outreach at Spera Management, and he's going to be here talking about ASEAN and UAE. Over to you, Manish. Thank you so much.
Good evening, everyone. As Prabha mentioned, so I represent Spera Group. I am director there, and my responsibilities are business development and the client service. So I am leading the client service department there. First of all, thank you for the IITM for arranging this a beautiful event and all the support staffs who are doing a great job to make this happening smoothly. So today, the US market and what are the legal frameways that has already been covered by the Ventura partner and the Ernst & Young. So my topic is I will walk you through, with a quick process, what are the practical aspects whenever you are entering in Dubai or in the Asian regions? What are the practical aspects you should think about it, and how you can choose a geography and how you scale your business. Okay, so this presentation is all about, I will explain you how you choose a geography, what are the tax implications, how you can increase your firm's valuation, and what will be benefit of having business in that particular jurisdiction. First of all, the very important thing is structure. This is the core principle which determines your firm's valuation. And why this is, very, very important? Because of the certain reasons. So let's suppose if you set up a holding company in Dubai, there is a 0% capital gain tax. So when you exit from the market, and if you structure it properly, you will be exiting that country without paying a single amount of tax. Also, there are certain technical things which you must consider while deciding your tax liability. However, from a general perspective, if you set up your structure in such a way, you will be getting that benefit for sure. So if your tax burden is minimized, definitely your P&L will be ending up with the higher profits. And when you are earning higher profit, it increase your valuation, it helps you to raise the funds rapidly. Also, if you structure your company in such a way, then it attracts investors, attention as well. So it helps you to create a great M&A strategy also. Now the most important question is how to choose a right geography. Okay, and by choosing a right geography, what benefit you can obtain. So we can decide this, by framing 3 questions. So one of the most important question is, what is your business model? Because selection of geography, it majorly depends on what type of business you are. Then the second question is, where do you need the advantage? Because some companies' perspective may be they want good exit, or they want a good fundraise, they want a better scale operation. So this is a question number 2. Now the third question, how fast do you want to scale? So that is also an important consideration while choosing a geography. Now, so based on our research and handling of experience, the lot of startups and the multinational companies, so we have derived a decision shortcut. The first one is, if you are planning to incorporate a holding or investment company, you can consider the Dubai market. Again, if you are planning a fintech or tech company or a payment company, you can again consider a Dubai market. If you are planning to manufacturing, you can check for the options of Malaysia or Vietnam. Now, if you are planning to have a great trading hub, you can again also consider Dubai because of the Jebel Ali airport, great connectivity with the other African and the other markets. If you are planning to have a BPO, back office, your operation, you can consider the Philippines. And if you have a SaaS scaling, if you have a product as a SaaS, you can definitely consider Singapore. Now see, the choice of best structure is not possible by choosing only one country. The best advice is always you make a combination of the countries. So let's suppose if you have a holding company in Dubai, you have your SaaS business in the market of Singapore, you have your marketing team working from BPO. So these kind of combinations give you the great valuation. And this should be the consideration while choosing any geography. Now, I will just talk about UAE a little more. So if you have a holding company, why do you need to consider UAE? So first of all, as I mentioned in my first introductory slide, UAE gives you the benefit of taxation. Although it's not 0% tax now, because they have imposed 9% of corporate tax on the companies, still because they provide you 0% capital gain, 0% personal tax. That is why UAE becomes the win-win situation for the Indian founders or the global founders. Now, what are the reason? Why should you choose the UAE for the holding company? There is a 0% capital gain, so when you exit the market and if you structure your business properly, you will be exiting without paying any capital gain tax. Although there are some tax complications, technicalities are there, but yes, this is a general rule. Again, there is a 0% personal income tax. In the free zones of UAE, there are a lot of free zones, like, there is a special economic zones in India. In a similar way, there are a lot of free zones in Dubai where they allow you to incorporate your company with 100% foreign ownership. And also, if you incorporate your 100% foreign ownership, they will also allow you full repatriation of profit. This is the, very, very, very important point, because there are certain countries in the Europe or in other region which puts a lot of restrictions when you repatriate your money from their country to India. Again, now one of the most important reason for Dubai's vision is D30. So basically, they are planning to become the global's biggest tech environment by 2030 in the world. So that is why choosing Dubai for your holding company could be a great move. And the process for incorporating a company in Dubai is, it is very, very simple. You can get your name approved, then you do the KYC, then custom documents, all these things can be managed easily with us, not a problem. Now again, if you are a tech company or a fintech company, again, you can select the Dubai, the UAE market. Now, Dubai, so you select Dubai not for the tax role play, it also help you in growth play. So if you are a tech company creating your company in Dubai, you are, there are very, very chances you will get a good, good amount of valuation. So I will just give you a practical example of this. So we are handling a client, and I will tell the, client name as well, that is Okta. So what Okta is doing, they are creating a solution for companies' account receivable with the help of artificial intelligence. They have their holding company in Dubai. Now they have set up their company in Saudi. Because of having a structure or the holding company in Dubai, they got $20 million of credit line from the Saudi bank. So this is worth, noting this point. If you structure your company carefully, you get access to a great amount of capital and a valuation as well. Now, within Dubai, there are two reasons. So these are also the, the specific free zones kind of reasons dedicated by the Dubai authority. One is the DIFC and one is the ADGM. Now, so there is a quick choice between DIFC and the ADGM when you should choose DIFC and when you should choose the ADGM. So DIFC is best for the payments company, for the lending and for the neo-banking, while the ADGM is best for the crypto, digital assets and things like that. Again, setting up a company in these specific zones, it's not a lengthy process, although it requires expertise which we bring on the table, but the process is simple. Now, if a startup who is dealing in SaaS, they can definitely consider Singapore. And why Singapore? Because Singapore gives you the access to 700 million plus customer and the Asian market. If you incorporate your company as a startup in Singapore, there are options available where you can get registered as a startup and you can avail the benefits of Singapore grants. So there are a lot of grants available for these startups. We can talk about it after this, after this session. And Singapore is also famous for the venture capital ecosystem. There are around 470 billion funding of, for the venture capital in Singapore. Again, setting up a company in Singapore is not a complicated process at all. It requires expertise, which again, we bring on the table. Now, why investor prefer Singapore? Singapore's compliance system and the regulations are credible and they are accepted by all the US and the European companies. Henceforth, due diligence process becomes very, very easy for the Singapore SaaS companies. As I mentioned, Singapore, gains a high global trust. There is an exit flexibility and also cross-border capital. So if you are having a SaaS company, there are a lot more chances you will be able to raise funds globally without any restructuring. Now this is, okay, so in this slide I have tried to cover, if you are having a manufacturing company, which countries in the region, in the Asian region can be fruitful for you. So you can select between Malaysia and Vietnam. So Vietnam comes with its own benefits. There is low cost manufacturing. There are tax holidays. So if you are incorporating a new company and planning to manufacture something, government will allow you tax holidays. Earlier it was used to be in India also, Section 80I, 80B, all these things. So that is what is still going in Vietnam. And then there is a strong export ecosystem. So Vietnam is a very fast moving economy. And I believe in the last year, they were the countries who has, the highest GDP growth rate. You can also consider Malaysia. So what benefit Malaysia provides for a manufacturing company. It gives you a better, better infrastructure, stable regulatory environment, and also if you are planning to make your manufacturing company as a headquarter, then Malaysia is a good choice for that because of its good infrastructure. Now, if you incorporate your manufacturing company in these regions, what are the key benefits you will be getting? Obviously, you will be getting the 30 to 50% of your production cost lower because of the cheaper labor and all other related services which are cheaper as compared to other market like Dubai or Singapore. In this region, around 26 billion of FDI happened in the year 2025. Setup time also, Vietnam is a country where today also there are a lot of bureaucracy, but again, we can help you to set up the companies in a time frame of 4 to 8 weeks only. By entering this market, although there are a couple of benefits, but you should also consider the risk consideration. Can you check this once? Yeah. Yes. So there are benefits, but also there are risk considerations as well, which a company must consider. So one is the complex approval, because as I mentioned, there are bureaucracies exist in the country of Vietnam, or for that matter, in few departments, Malaysia as well. So approval process is complex. Now the second thing is repatriation delays. As I mentioned, repatriation of funds is very simpler in Singapore or Dubai, but it is not simpler like there in Vietnam or Malaysia. And the third is the regulatory changes. So just like in India, every quarter there are new GST, notifications, regulation, rules, everything. These countries are facing the same thing. So that is why there are certain kind of risk. Before entering this market, an entity should consider these as well. Now, if someone comes to the market, the Dubai, Singapore, or the other countries of Asian region, what benefit they get? So they get talent advantage benefit, because the per hour cost, if I compare with the US or the European market, in these regions, the per hour costing is almost 50 to 70% less, and hence it improves your EBITDA. And if your EBITDA improves, obviously your valuation will go high. And here is the tax snapshot for these 4 countries. As I mentioned, in UAE, 0% tax rate for individual, even for certain qualified free zone entities also. And then there is a 9% of corporate tax. In Singapore, the rate of tax right now is the 17%. That is the effective rate of tax. In Malaysia, it is 24%. In Vietnam, there is a range. But as I mentioned, there are tax holidays in this country for 4 to 9 years. Now, after incorporating your company, getting this benefit, right, what will be the end result? The end result will be the lower burn plus higher margin. So if you have these 2 things, obviously investor, think about your company, and it also help investor to increase their return, whatever amount they have invested. Now, so we talked about how to choose a geography, what are the tax compliances and the tax rates, and what kind of government incentives are available. When you enter a market, you definitely need some support staffs. Now, there are 2 strategies. One is the EOR, or second one, you set up your own entity. So what is this EOR? I will just explain in simple words. So let's suppose if you have to hire your employee during the phase of your research and development, what you can do? You can hire employees on the payroll of a local entities. So in that case, you are free from the complex compliances. And till the time you don't scale your business, there is no need to set up an entity. So having an EOR entity as your partner, you can very well do the research in that market, that too free from the complex labor law compliances. And once your business is up and running, then definitely for scaling your business, you should set up your own entity. Now, how geographies help you to uplift your valuation? So you have set up your holding company in UAE, which attracts the UAE, Singapore sovereign bonds, grants, and the MENA LPs. Then you have your operation in Asian countries like Malaysia, Vietnam, Philippines. Because of the low talent cost, your operation will scale there, and this clean structure, having a clean structure, will give you an extra valuation of 20 to 40%. So that is the, these are all the benefits, and by entering into this market. So I'll move on the next slide, how we can help you. So we can book a session with you for 30 minutes, wherein we will be talking about how to select a particular geography, and then what are the recurring compliances, what all support we can provide. If anyone is interested, we, along with the Ventura partner, we are here. You can discuss your incorporation or expansion strategy in the market of US or in the other Asian regions. We are here to help you. Thank you so much.
Felicitate Ventura Pranas team. Request Ms. Prabha to join us on the stage. Thank you, Ms. Prabha. Ms. Ramya, Ms. Madhumita, Sai. Preetika. Mr. Manish from Spera, please join us. Thank you, sir. So as we close, here's what stands out. We are no longer asking if IITM startups will go global. We are now asking how fast and how well. So this is not a workshop, this is the beginning of a global movement from IIT Madras. The next global deep tech success stories from India will not be built in isolation. They will be built through ecosystems like this, and many of them will come from this room. Thank you for your time, participation, and energy. We look forward to seeing more IITM startups scale up globally and create the new way of deep tech success stories. If you're interested in membership, please stay back and engage with the IITM Global team. Have a great evening. Thank you. You want to read the question?
Can you call out the question, or can my... Okay, so there's one question. So they're into a SaaS solution for a marine industry. I'm assuming it's all Indian. Our target customers are ship managers and ship owners. So I'm guessing that it is agnostic to whichever country. So a lot of ifs and questions to this. Which country is ideal? Okay, so he is responding. Sorry about this. Okay, which country is ideal to open a sales and implementation office? I think it's important to address where the largest customers are. It is hard to tell from Mr. Muthuswami's question on which country he's targeting these customers. If he's going global and going outward to no matter which country, and this is developed in India, I don't think he needs to set up a sales office anywhere else if he's selling out of India. It could just be very much an Indian company. But it's worthwhile checking where the largest traffic goes through, given that we have this crisis in West Asia. We've just been sensitized to how much dependence there is to certain geographies. So I think I would want to ask Mr. Muthuswami more questions before I can give an answer. The next one is for deep tech startups currently in TRL3 with IP filed in India. What is the right stage to consider a US holding structure before funding, before customer pilots, or after initial commercialization? So it sounds like this company has all the IP in India, and it sounds like they're looking and they've decided already that the US holdco structure is ideal. My answer to this company is as soon as possible, because the further along you get, you're going to have valuation issues. And if you're going to have a US parent hold an Indian company that is going to own a lot of this IP, it's considered export of IP. And the moment that happens, you're going to go through a valuation and a tax outcome as a result. So my answer to you is, if there is visibility of revenue, you're already in a pilot stage, I think you should start it, get to it ASAP. The next question is, how do we get details of IITM membership, especially for one who joined online? So that's for you, Madhula, but I think you can address that. Okay. Yes, I think they have your registration details, and I think it would be their next approach to actually contact you via the registration, telling you what this membership gets you, and you can go from there. Yeah. Okay. I think I got it all. Thank you, everyone. Thanks to the people who attended online.
Thank you.
Yes.
Thank you very much.
Okay.
Are there questions here? I think all these three questions are interesting. The third one, I think details are available with Madhula. She'll be able to share with you. I think in a brief, as far as membership to IITM Global is concerned, first of all, on one side, your own readiness. I think that is what Prabha is talking about. You should know and you should be in the right position. We are here to add value to whatever you feel you are at right now, you're ready to go. And then we have found a few startups here that came to us, and we've been able to advise them that they probably are not yet ready. Okay, and we've been able to point out what the reasons are. But I think first and most importantly, when you're going global, I think you should be very clear because you're obviously moving into a new country, and there are many more aspects to it, but one of the most important aspect is the psychological aspect. I think that many people need to be ready. Okay, that's very important. It can hit you hard. It may be very exciting, but once you go there, this has happened to people who have also gone. I mean, I've gone very young at about 21 to a country like Japan, and it hits you hard. So you need to be very much mentally prepared. So that's very critical. I think many people don't talk about it. That's very important. But I think once you have crossed that, then of course, market fits. Actually, we are at a time when very difficult to say. I mean, I would have jumped and said, if you're talking of ship owners, etc., being one of the largest redistribution hubs in the world, a gateway to Europe, Africa, and to many countries, Dubai would have been an automatic choice, but we don't know. Today, I mean, the situation is changing. So one of the things that I would reiterate for all of you is to be aware of what's happening around when you make those choices. We are there to definitely help you, guide you, and we have our partners who can also further give you more insightful information. But I think take that into consideration because it's a very dynamic world today, so you need to understand what's going on around you. And that doesn't prevent you from going outside. There could be other pockets of opportunities that come up. I think there was a presentation made of various countries, Malaysia, for example, or Southeast Asia. ASEAN countries are probably today, hope they recognize that they can actually open doors because a lot of people will have a little bit of inhibition right now to go into the West Asian market, for some time at least. So then ASEAN is an opportunity that you can look at. And most technologies, today is an integrated economy globally, right? I mean, it may not be very mature in a particular market. As a person who's been, I would always go into a difficult terrain to go and develop my business. Because I believe very strongly that I can add more value in a market that does not have basically a particular product or a solution. I think you are forced to do much better. Many of you would know about Redington. Redington started in Singapore as a trading company, but they chose difficult terrain. So I set up Redington in the Middle East Africa region when nobody would have gone. But today, look at where that company is. They're going one full cycle developing business in the most difficult terrains. They've added a lot of value. And now they're going and actually hurting people in the developed countries, right? So that's another strategy. So think of that approach as well. You don't have to be very stereotypical in terms of how to approach, right? So that is something that you need to also think of. And I think IP was extremely well answered. I think that's very critical. Be a little careful. So if you want to do it very quickly. Don't get into a problem where you will end up paying taxes and all that. Please understand one thing that many people don't know when you leave from, I think there was a discussion or a presentation by EY in the morning on cap tables. Be extremely wary and careful of that. Okay, and when you move, some startups do move, they relocate completely, take their headquarters from here and take it to another country, which is fine at the end of the day, but be aware of
the tax regulations, particularly exit tax and all of that. So you should be very, very clear. So you can reach out to us at any point in time. More than happy to help you. Actually, it is, I may not be wrong in saying that there is no one size that fits all. It's on a case-by-case basis. We do a lot of work in terms of who probably can fit into which market. There is a fair bit of understanding collectively amongst us, and with our partners, we do know a lot of markets. It was good to see a lot of positives about Dubai. I've lived there for about 27 years, so I've been there through the growth of this city. I work for the government of Dubai as well. So, but yeah, today, is it the right time? We don't know. So, but hopefully they'll bounce back. Very resilient leadership, so I'm sure they'll bounce back. But that doesn't deter you from looking at other markets. So there are a lot of other markets that can still help you. And if you go by my philosophy, when there is an adversity, there will be an opportunity, I will go into Dubai. Right? So, because they do have clear plans to come back, and it's an easy place to do business. That's how they have positioned themselves. Easy to go, set up, easy to access markets. And you don't look at Dubai like Singapore as the local market, the huge market that is around you. Right? So, good. I think if there are no more questions, thank you for coming over. Yes, absolutely.
Even before
absolutely.
setting up the...
Absolutely. In fact, that's what I said in the morning presentation, that our approach, just to, with risk of repetition, our approach into global markets, first of all, is we will establish our own footprint. So we will have our own office there. And then there will be space available, so space will be provided for, which is very critical. If a startup moves to a global market, space is number one, very important. So number two is we will have our own footprint, plus we have go-to-market partners in all these countries. So these are people who have established their operations there and have been around for, most of them are 2-3 decades, so they know the markets extremely well. So they will be able to help you to get your first customers, right? That's very critical. Without any doubt, I said this in the morning, that we will definitely handhold you all the way through. We want to see that you grow, and we don't end up at just probably you getting your first customer. We are quite keen to see how you grow in that market, right? Sometimes the first customer will be great, but then after that you don't know when will be the next. So we will be there through the journey.
Just to get a bit of more understanding, like it becomes also domain specific, right? If it's deep tech or something. So how, like for example, I come from a semiconductor domain. So if you mention the go-to-market strategy or the partners and other things, so how established or how it is like through the IIT?
See, fundamentally, most of the team in IITM Global are all from the tech domain. I've been in semiconductor, yes. I've been in PC, I've been in communication. So we do understand domain, but otherwise we bring in domain experts. That is something that we do leverage on, and that's what IIT Madras provides. So we have obviously connects. We do work, faculty is pivotal to us, so we do lean back on them if we want to understand a little bit more deeper. So when there is, obviously, if your question is if there's a gap between the GTM partner and you, but we are there.
Okay.
We are there. So we leverage back on the institute, right? So subject matter expertise is available with us.
Okay. Thank you. Thanks a lot.
Thank you.
So good evening, sir. I'm
Good
Sanjeev
evening.
Kumar in IIT Madras Incubation Cell Startup Company, International Phytomedicine Innovation Private Limited. So recently launched our product here only. So last month successfully launched our product, particularly for medicine for malaria and HIV virus. So we have everything, license everything. We are doing bulk production. So we are focusing on market strategy, particularly in India. India we still started, but we need support from the because our customers are from African countries. We need support from IITM Global to market and commercialize in there.
Absolutely. So Africa is a market I mentioned in the morning. Africa, we already have been there for about 3 years. Yes. So we are established in Zanzibar. So we do have connects. But since you are in the medical or medtech space, Someone? Oh, somebody's online, okay. So one thing on anything to do with the medtech side is the regulatory. Regulatory is very critical. If you want to go into any country, you need to have the approvals in place. That's something you need to be aware of. While we can go to the market, but you need to ensure that your product meets local standards, local regulations before you can start pitching and marketing. So that I think will come as the next step. I think we'll talk more offline.
Yes, sir.
I think you'll meet up with the team, understand your product much better. So we had a very disruptive technology startup here, and we have asked that startup to focus on getting the regulatory approvals. That's very critical when you want to go outside, particularly in the space of medtech.
Yes, sir.
And I think this applies to almost all hardware products. When you want to go out to different markets, I'm sure it would have been covered in your presentation, regulatory approvals, standards, all of these are absolutely critical. That's something very important, and I'm sure foundationally, any IPs that you may have should be internationally registered. Many startups, I don't know, I call it penny wise, pound foolish, they do not register their IPs internationally. That becomes an issue. So always look at those aspects. That is very important.
Sir, actually we have globally patented, sir. We have patented
Good,
globally.
excellent. But then the regulatory things will come in.
Pan-India license we have.
Pan-India is good, but you're looking at going to global markets, right? So I think that is the point I was trying to make. So make sure that that is addressed before you go.
Yes, sir. That is only need. Okay, thank you.
Excellent. Thank you. Good. If there are no more questions, thank you. Thank you for coming. We are here. And if you feel, as we said in the morning, if there are other areas that we should probably cover to get you more information, please let us know. We have tried to be as comprehensive as possible. Thank you to our partners who came at very short notice, to EY as well, Prabha and team. Thank you so much. And we are here. We are reachable, accessible. Madhala, can I say 26/7? Thank you. Thank you so much.